But go ahead. You said you got a
Nah, but
letter.
yeah, in all honesty, yeah, but seriously, it's Epic Prep the Survivalist. That's the name of the YouTube channel.
I'll put the link in the description. Y'all go subscribe to the channel.
Yeah, so I got this letter from the mortgage company, and it's the letter that everyone wants to get. It's the one that tells you that your mortgage payment's going up. So I was like, what the heck is this?
And I got the same letter, and it's not just. I think the point is that everything's going up. Like you're probably not going to get a letter anytime soon saying your mortgage is going down.
Yeah.
And even if you already have a mortgage and you may think, oh, I'm protected, my rate's already locked in. No, escrow is still a thing. And, obviously there are reasons that you're going to go into that affect your escrow.
Yeah. So there's a lot of myths that go into real estate, real estate in general as an investment. So one myth that people think is when you get a mortgage and it's a fixed interest loan, my payment's never going to change. So I don't have to deal with the problems that renters normally face. My rent's going up this year, whatever, right? And obviously everybody's getting those rent increases now. But you think, all right, I'm buying a house. It's a great investment. Yes, it is. I'm not going to argue that. But to think that when you bought a house, you've now forever fixed your expenses is not true. So a lot of people don't realize that mortgages are based on four components, or your mortgage payments based on up to four components. It could be based on two because I've done it, but now it's based on four. So it's what's called PITI, PITI. You got principal and interest as well as taxes and insurance. So let's just talk about the principal and interest. So your mortgage is at a minimum, it's based on those two things. Principal, you're paying that down. That's how much you owe, and the amount of interest is assessed per payment. Now, previously, my first house, it was just PI. It was principal and interest. I paid my mortgage, my property taxes separately. I got a bill every year, which went up every year. And I paid my homeowner's insurance separately every year.
I don't think they allow you to do that anymore. I think that you have to have your insurance, maybe not your insurance, but your taxes have to be in your mortgage payment escrow. Like, I don't think they let you choose anymore.
And that would make sense because it's like, and honestly, it would make sense if they don't let you pay any of it separately. Because on the one hand, to your point, if you don't pay your taxes, the state's going to come get your county is going to come get your house, or force it to maybe be foreclosed to extract the taxes due out of it, and then of course it's leaving the bank in a bad situation. And then two, if you don't have the homeowner's insurance in there, if you don't make a payment, now your insurance gets canceled, and if something catastrophic happens to the house, now
They're not protected.
right.
And so just to give everybody watching a little bit of background on principal and interest, if principal and interest was the only component tied to your mortgage, then theoretically your mortgage would never change.
Right.
Because if you have a fixed rate, if you had an adjustable rate mortgage, then yeah, it could change if you had a balloon payment or something like that. But on a conventional loan, the principal amount per month that would be paid part of your payment would continuously go up. So each month, each payment, you're going to be paying more towards your principal as you're sort of equally paying less towards your interest until you get to the last payment, which is going to be mostly principal. So, if you're in that situation, you may not see, if you have an older mortgage that allowed you to have just principal and interest, you may not see an increase, but that means that every year you're getting your own separate bill for property taxes that is going to go up. It's going to go up.
Yeah.
And they went up a lot.
Yeah. I mean, obviously, if you live in New York, you're going to look at my property tax bill in the previous house I lived in and be like, why are you complaining, right? But when I first moved into the house, when we first bought the house 13 years ago, we had a mortgage, or we had a property tax bill like $2,400. By the time Fast forward 13 years, the tax bill is like $3,500. So that's like a 50% increase,
So you went from $200 a month to $300 a month.
basically.
Why?
Your house gets reassessed every so often. Some counties do it every year, whatever their interval is. But if your house is appreciating and going up, well, guess what? The new assessed value of your house is going to change how much taxes due.
Yeah. So, the counties, and they're looking at it. If you watch my last video, you'll understand that everything, pretty much 99% of what goes on day to day is about money. They're looking at it like, yo, these properties are going up like unbelievable amounts. What are we going to do? Oh, we're going to reassess because we're working on percentages. So, if their house is worth more, then we need to be charging them more.
Yep.
For what? For nothing really.
Yeah.
That nothing's really changed, but they can.
Yeah, you're existing still. That's why we're charging you more. Oh, and guess what? In 2008, 2009, 2010, I would be willing to bet they didn't assess as frequently then. Why do we want to reassess when the housing prices are going down?
Oh yeah, you would have to actually request that, or like the homestead exemptions and things like that to get it to go down. And it's about the money.
Oh yeah.
So it went up.
It went up.
And
and so it went up, and it changed my payment by $106 a month.
Yeah, so it's not changing your principal, it's not changing your interest, but the overall payment, because it includes the taxes, is making the total payment go up.
Yep.
Was there any recourse? Was there any objection? Anything that you could do from getting the letter to try to stop it or reverse it?
Yes. Now, there may be more than one option, but the first option that comes to mind is, since the reason why my payment went up wasn't taxes, it went up due to the insurance going up on the house. I could technically maybe raise my deductibles and bring that
I got you.
premium down, or maybe lower the coverages.
Okay, so you're saying that it went up not because of taxes, but because of insurance.
Correct.
And I actually spoke to Complete the other day. So I deal with Matt, and you deal with Mike.
I used to deal with Mike. Unfortunately, he passed.
Oh man,
Yeah,
I didn't know that.
I got the bad news not too long ago.
But he was telling me, Matt was telling me, when we bought this house, so like a year and a half ago, he said that the replacement costs are going up like 15, 20 at the time, like 15, 20, 30%, depending, based on the cost of lumber, the new labor prices, et cetera, et cetera. And now the high, and that was before the home started getting this appreciation, this new appraised value. So I wouldn't be surprised if I asked him today. He goes, if replacement costs are up 50%, that would make sense for yours to go from 200 to 300, or 2,400 to 3,500, and that's how you see that increase on the payment collectively through the insurance change. Because, and this was like the video I posted about why you need to make sure your credit and cash is in order in case something happens that you're not prepared for, you're not planning for. For instance, a vehicle, a tree falls on a car and totals it out.
Right.
But the replacement cost of that car is going to be far greater than what it was when you bought it. And, so you may have to finance it. You may have to put more cash in to get it. And that's why the insurance is now cost more, because they're paying it too. And if you have a situation where the insurance is paying for it, then that's great. And, you have that support there. But if not, then you have to find alternatives like adjusting your deductibles. But all that does is potentially make you spend more later.
Yeah.
Like you want to save $100 a month, but now your deductible has been doubled. So an occurrence that, and this is on your home, so an occurrence that at one point in time might have cost you $2,500 to file a claim may cost you $5,000.
And that's a big deal for a lot of people, for most people.
Yeah.
I know it's a big deal for me. And then it's like, okay, let's just say you can't reduce your coverages for whatever reasons. Maybe you're already at the lowest, and so you can't reduce them down beyond that, right? Then your only other alternative would be to reduce your or increase your deductible, increase your deductible so that your the risk that the insurance company is taking on is lower for them, so that's why your rate goes down, right? But it's like, all right, if your deductible was say 2,500, now you raise it to 5,000. How much are you even saving per year? A lot of times, it's not even that much. So now you're taking on all this extra risk yourself, and so basically, you need to have at least a $7,000 or more expense in your house to even make it worth filing a claim, knowing you're going to come out of pocket $5,000 for your deductible, and then knowing next year your insurance is probably going to be higher because now you got a claim on your record.
Yeah, not to mention that I don't know how the mortgage companies do it, but like auto loans, they limit the max deductible because they don't want to have a situation occur where the deductible is too high for the person financing to actually pay it to get any
Repair
claim.
needed. Gotcha.
Yeah, so they may limit the deductible on an auto for like $500 because even though 1,000 is available, they're like, nah, we don't want to do that because you may not be able to do that and fix our car. So I don't know if the mortgage companies do that too. Like, we don't want your deductible too high because you'll never repair the house like it needs to be because you can't afford it.
Yep.
So,
And that's their collateral. So if the house goes to complete crap, and if they ever needed to foreclose, then they're burned on the back end. They don't care. They don't really care about your house. They just want to make sure they get their money.
oh yeah, they want to protect their interest. That's it.
Yep.
That's it. Speaking of foreclosures, they're up for February.
That's a funny figure.
They're
It's up depending upon what you're comparing it against, right?
yeah, year over year they're up.
So how do you remember what it was last year?
Oh man, I don't remember what it was last year, but I know like the year before that it was really high.
Okay.
Well, it was normal. It was a normal rate. Now the foreclosure rate for February that I saw the other day for 2022 was low, crazy low, but it's technically up.
Yeah.
But you brought up a really good point earlier today. We were at the Porsche Experience Center.
Oh yeah, dude. We literally just got back. That if you haven't checked it out, you got to.
Yeah, we did the one in Atlanta. There's one in Birmingham, and there's another in LA, and really cool. And you brought up something while we were there waiting for him to call us, and you had mentioned phantom inventory.
Oh yeah, yeah. So they have different names, but it's like shadow inventory.
Shadow inventory.
Yeah.
Possible foreclosed homes that banks are sitting on that no one really knows or
Right.
foreclosed on that could potentially change the game in the real estate market.
Oh yeah, absolutely. Now, first of all, you heard too big to fail. So you got all these banks, different levels, right? Banks, they're just trying. They're a business at the end of the day. They're not trying to lose any money. They're trying to make money. So let's go back to 2008 because that was the first time I ever heard that term, shadow inventory. So there was a point where there were so many foreclosures going on, and part of the reason why the housing market crash happened was not because a foreclosure doesn't make the housing market weak. It doesn't make it crash. It's when there's so much inventory on the market and not enough buyers to meet that demand, and then prices have to continuously be reduced to compete for the few buyers that are on the market. So what was happening is with the wave of foreclosures, all these banks were releasing all these houses inventory on the market, and there wasn't enough demand in the form of buyers to buy it up. So it got to a point where housing prices just kept going down, 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 down. And then at some point, the banks were like, you know what? We're fighting each other, and we're all just trying to survive. Banks were closing. You guys remember that, so I'm not going to go into that. Point is banks started getting smart. They were like, hey, with all this quantitative easing and Fed money hitting the market, the banks were getting bailed out. It was a very common term back then. So the banks said, yo, let's take some of this money and let's just hold these properties, because if we hold out long enough, this inventory, by holding out meaning we have these foreclosures, we got all these, but we're not going to release them on the market because all we're going to do is further push the prices down, and we'll get less and less for each one of these houses that we're holding. we're just gonna take them off the market, let the market kind of dissipate, and now there's not so much inventory. Once that gets bought up, now there's less and less stuff on the market, less and less houses on the market. As more and more buyers come in, now these prices stabilize, and then eventually there's a shift, and then there's more buyers than there's properties, and then the housing prices can go up.
And the prices stabilize towards a higher end of the spectrum. And I don't want to completely shift gears here, but we have talked about the possibility of this actually happening in grocery stores by not loading the shelves up with everything that they have to create a sense of scarcity, provoke different buying habits, bulk buying, panic buying habits, while maintaining higher prices, ultimately higher profits, versus, oh, the shelf is completely full and there's an overstock and there's some up top and there's even some in the back. I don't need that today.
Get it later.
Exactly.
And then that business is getting less sales that day because you don't feel the need to buy that day.
Right. And it's not, it's not something it's really probably something more of a want than anything. And you just don't need it. So it's like, oh, I'll just wait because I'll get it when I need it. But even if it's a want and there's only one, you're probably going to buy it because you're like, yo, when I do actually need it.
I don't want to come here and it's not on the shelves.
Right. Right. So, but this can and does happen in multiple markets besides just grocery stores. So, it could happen. We don't know for a fact, but it could be happening in real estate and through the banks and their foreclosures. But, they're a business and, they're probably have their assets are huge, unbelievable. They have the ability to wait. They have the ability to for time where some people do too, depending on who they are and the position that they're in financially and what they are potentially selling. So some people may have looked at the housing market and was like, I could have sold in 2020, but I don't need to. So I'm going to hold off. See what 21 brings. Could have sold then, still don't need to. Let's see what 22 brings.
Man.
They have that ability where some people don't. Some people are like, I have to sell, I have to move. For instance, the people you bought your house from, they just bought it, but had to move to another state, like
job transfers,
and they didn't necessarily want to keep it. So
and try to rent 1,000 miles away.
Yeah. So, it just there are some people, there are some businesses out there that do have that ability and will look to the future of, should I really unleash this now? Or like for me, I like to look at Auto Trader. I love Auto Trader. And when it's time for me to unload one of my cars, which I do often, I'll check and see what Auto Trader looks like because I don't want to unleash one of mine when everyone else is unleashing theirs. I want to wait until I'm like, there's a handful of competitors out there, hopefully not even in a 200-300 mile radius of me, so that mine becomes more valuable.
Right.
It's
like, because when you do, it's like when you release yours on the market, it's like, if you really want this one, you're going to have to buy mine at my price.
Yeah. Or you can travel a further distance and get something that's not the same or even comparable, And so, it happens. It happens. And, this is, a word to the wise. If you're paying attention and you find yourself in the situation where you're looking to sell something, you may want to just weigh your odds on the timing. Now, no one has a crystal ball to know what tomorrow will bring, the future will bring, as far as, conflicts that can drastically affect our economy or the president and any executive orders or anything. The Fed raising rates, which we know that they're going to continuously raise rates this year. We don't know exactly how much, but we know they are. And somebody said the other day, Michelle, you paying attention? Is she over there?
I don't see her.
I think our interest rate on this house was like 2.7 or something, 2.8%, 30-year fixed mortgage.
Wish that was available today still.
What was your buddy's
Man,
quoted with great credit?
with great credit, yeah, and excellent stellar job history, he was quoted 4.3%.
4.3.
Yeah,
4.3. So we're looking at roughly what was that
that's a
1.6% increase over.
I just closed 8 months ago and we got 2.8.
All right, so let's say you got 2.8 and he got 4.3. So we're looking at 1.5, 1.5% difference. And you said you did the math to determine how
Oh,
much
yeah.
more
Yeah.
that would cost monthly just from the rate change.
Just from the rate difference on a $500,000 house, it was a $450 difference per month on your monthly payment. You tell me how many people are going to keep being able to chase houses when interest rates are going up at the speed that they are. So
That's $5,400 a year.
that's, dude. I mean, that's more than my property tax was at the old house. That was $2,000 more just in a rate change in a matter of 8 months.
If you're just now jumping in on this video, I want to reiterate that a 1.5% rate change on a $500,000 mortgage is a difference of $450 a month. That the Fed just did like that, with more promised for 22 and planned for 23.
It's ridiculous. It's ridiculous. So many people were looking at Jerome Powell like, yo, when's this guy going to try to address this hyperinflation? You know, what's he going to do? Oh, and the Fed didn't respond as quickly as many economists and investors and people alike. Anybody impacted by inflation wanted something done about it, right? But the problem with the economy is it's not like, like this button on your phone where you hit it and it unlocks the screen and it does this one thing. When you make adjustments with the economy at a federal level, it's going to create this unreal cascade of events to happen after a change is made. You change the interest rate, you bump it up 25 basis points or 0.25%, and it's affecting everything. And you may not see it right away, but imagine you're on the highway and someone's driving and they're, messing around with their phone. They drop it and they go reach over to pick up the phone. They swerve a little bit, trying to keep the vehicle, on the lane, in the lane. The person next to them tries to adjust for this person who did this one little thing. Well, I just wanted to reply back to this text right quick. So this person swerves a little bit. This person tries to correct this other person in the lane to the right, overcorrects, freaks out. They're a new driver, right? And so this whole cascade of events happens. People behind are watching everything. They're slamming on the brakes because they don't know what's going to happen. Let me try to avoid this collision. And everyone else behind them is all. So the economy is the same way. You turn the knob a little bit, going to bump up 25 basis points. All this other stuff's happening in the background
that you didn't know was going to happen. You have an idea, you think you know, but you don't know for a fact.
Right.
You don't know for a fact. And, despite the rates going up, Bitcoin continued to climb. There's continuous faith in this cryptocurrency. And, I think the ridiculousness and, irrational behavior with the US dollar is just going to further drive this cryptocurrency into the new world currency.
That global currency. And it's funny, gold used to be that asset class for safety. Dollars are, if the US, because the US dollar is viewed as the global currency, is the main currency used for trading oil, even when it's not US transactions in oil. OPEC and other oil distribution facilities would, for the most part, trade oil in U.S. currency.
Yeah, that was like mandatory or something.
It was mandatory. Recently, OPEC has been in discussions with China to trade oil in yuan or yuan, however you say that.
Man,
So that's really putting a challenge in terms of the dollar's global value.
I think these are the things that we need to be paying attention to, not just, the amount of food on the shelves or pasta or, avocados.
I apologize. Saudi Arabia. Saudi Arabia is in talks with China about trading oil in yuan. Sorry about that.
No, but it's all good. But these are things we need to be focused on. Yeah, sure, this could have an inverse reaction to food availability, food insecurities, and prices. But I don't necessarily think that it could potentially overnight make it so that food is not on the shelves and unavailable everywhere. But what could possibly happen is make food very expensive.
Man.
And it's not just food, it's everything. But if it comes down to it and you say, hey, look, I only need to buy what I need, food is high on the list. You don't need certain other luxuries that you can go without regardless of how expensive they become. But food is one of the ones that you're probably going to have.
Food, gas.
Yeah, And, you could probably get by with gas depending on your transportation means and methods and things like that. But food, that's what I'm saying. It's like
Unless you got a garden in your backyard.
Yeah. Yeah, but even still then, like, you're going to consume it faster. You need a farm. You don't need a garden. You're going to consume it faster than, you can grow it. And, but these are things that we need to be paying attention to and being prepared for, because these are those small little blips on the radar, the key indicators that I was talking about before my other video, that are going to lead up to something big. And when that big thing happens, and you're going to look back and be like, oh shit, that was when they did the oil and they changed it from the US dollar to this. And, and Jerome Powell, he changed the rate. And like, then you're going to start to see all these things come together after they are together. We don't know exactly what's going to happen, but we can look at these events and these little steps, the baby steps, I'm sure you guys watch Dave Ramsey. You know about the baby steps. These are different baby steps. These are baby steps that are going to really hurt everyone, but more so the lower income, middle class. It's really going to hurt. I got a comment on my video about the food shortages in Target. I put that up 4 or 5 days ago. And one of the comments said, those who aren't prepared are going to see this in 60 to 90 days. And so these are the indicators. And if this comment is actually true, 60 to 90 days from now, if you didn't act on this and you look back like, damn, he told me that was it. I wasn't paying attention. And so you gotta prepare and plan based on what what could be possible, what you're capable of. And, you don't want to just sit there and just wait and see what happens and have no plan, no plan,
no strategy
whatsoever. And, I think these are things that we really need to pay attention to. And the other thing is, obviously, things costing more, inflation, hyperinflation, rates increasing is not going to be received well by the general public. So is there a push for a reversal?
Is there a push for a reversal in the interest rates?
Yeah.
Well, so here's the thing. The Fed has these meetings, these FOMC meetings. Don't ask me what that stands for. But they have these meetings every month or every other month, and they'll release publicly what their plans are. Last I heard, the plan was 6 or 7 more rate hikes this year. And additional rate hikes without a number associated, the last I heard, were expected for 2023. Now, they can change their mind, and they can change how much of a rate hike each hike is going to be for, right? So this first rate hike, or the last one, depending on how you want to look at it, was 0.25. So that's 25 basis points. So the next one, according to what I'm seeing and hearing, they were saying that it would likely be more aggressive than the first one. So the next one is supposed to be probably half a point.
Ouch.
Yeah.
So, if as you're saying it, you got to think about it, right? They're going to raise these rates aggressively. Why? because they got to make up for lost time. Just like the other big companies and big corporations that weren't making any money in 2020, they're making up for lost time. So yeah, things were great, pie in the sky, mortgages at 2.7, 2.8, great. Okay, now we got to make up for that and then some.
Yeah.
So this could be, this could be a big deal coming down the road. I read one article the other day, and it says that Biden's proposing a tax on households that are higher income households.
So more tax for the people who are already paying a lot of tax. I mean, let's just be honest. They do pay a lot of tax. But so he's looking to impose an additional tax.
Yeah, it read over 100 million.
So it's like no one I know.
Yeah, it says like the 1%, like over 100 million. But the way it reads is like, is it over $100 million in tax revenue, or is it a tax on households that make over 100 million? It was really kind of hard to decipher that one. But yeah, like they're making up, like they got to make this up. Like they printed the money. Now they kind of got to account for it.
It's funny you mentioned that, the print of the money. I wonder how much money actually really went into circulation, because you hear about all these $1 billion, $1 trillion. It's funny. We used to not hear the T word used that much, but after the pandemic hit, you hear the T word getting thrown around all the time now. It used to be B's, right? So $1 trillion package here, $1 trillion package there. So you have these multiple $1 trillion packages rolled out. And so that's the big top line number. But then it gets broken down into all these little subfolders, and the money is allocated for these different groups. Much like with business, with government contracts, a lot of that money ends up going, it's allocated, but it goes unspent.
Yeah.
So I'm wondering how much money is really in circulation now, because we had these different packages that got rolled out. And if we let's just take one off the top of my head. There's one program for like rental assistance.
Oh yeah, that's where I was going. And
it was like $50 billion allocated to it, but like
could never get to the people. Could never get to the people.
The criteria, you got to jump through this hoop of flames while carrying this rare fruit in your teeth. So it's like you have all this money that was allocated, and it was passed, and it went through this. It was passed, and it went through this whole stimulus package, or whatever the package was that passed this money for these reasons. But if the money doesn't get spent, it's just allocated. How much of that really affects the value of the dollar? Because the dollar is based on, the value of the dollar is always based on adjacent currencies. But it's like, okay, if this money was allocated, but it's not in the market, how does that really affect the value of the dollar? Like, did you approve? It's kind of like you're approved for $50 million. Imagine you got a credit card from Chase, JP Morgan Chase gives you a $50 billion credit card limit, but you only spend $5 billion. Not only, but you get me, right? So you spend $5 billion, you've got $45 billion left that you didn't use. So
yeah, you haven't made a huge impact on the economy because you haven't used but 10% of what was available.
Right. And so now there's only $5 billion more dollars in circulation, not $50 billion.
True.
So so that remains to be seen.
Yeah. It's going to be interesting to see how things go here in the next few weeks, really.
Yeah.
Because things are moving pretty quickly. And we are now getting into once we get past spring break, which, it varies depending on where you are in the country. But once we kind of get past spring break, we're getting into like the beginning of the housing market season.
Oh, yeah.
So we got.
And it's starting already.
Yeah.
It's starting.
We got rates already that have increased, planned to increase more. And prices continuously going up.
Yep.
I don't know.
Well, and here's the other thing. So interest rates are going up. Housing prices are going up. Insuring your property is going up. So the traditional scales of affordability are completely changing.
Right.
I'm waiting to see how the banks are going to respond in terms of approving people.
Okay, so with that being said, there used to be a time where 60 months on a car loan was a long time, but
Nice.
then the cars got more expensive. And I think that was by design because the car manufacturer was like, hey banks, can you increase the length of time that these loans can be made on these vehicles? Well, banks are like, yeah, sure we can, but they need to cost more. Oh, well, how much more? You don't say. Okay. All of a sudden, cars cost more now. Why? Because the banks are now doing 72 months. Yeah, there's a little bit higher percentage on the APR, but it's a longer term, so your payment is lower, and people are making more money, i.e., manufacturers and car dealerships. And now we've moved on to 84 months, and beyond that, I don't know what the next number is.
96.
I don't know if it just jumps out if it goes to 90 or maybe 88, something weird. Who knows? But the thing is it's continuously like there used to be a time where it's like 36 months is the time that you're going to finance a vehicle.
Right.
But the vehicle probably wasn't the average new car price today of $45,000. So, you have to extend it. So house prices have gone up. We've seen the appreciations, the rise in everyone's equity. Rental costs have increased because of that.
Yes.
Multiple reasons why rental costs have increased, but we can talk about that at a different time. But the rental rates have gone up to match housing. I mean, you're not going to go get a deal there. They're like, look, it is what it is. Like, we can save you on a credit check and a down payment, but you're still going to pay to rent here. So they're going up. So if you want to get into the house, but maybe we're getting to a point where it's becoming so far less affordable. Maybe the banks look at it like the auto industry and it's like, we need to extend these terms.
Hey, I wouldn't be surprised, and it wouldn't be the first time that they've done it. You just called it out. The auto industry did it. Used to be 36 months. I remember back in when I was a kid, I used to watch these Honda commercials, and this guy named Danny, he was like the sales guy in the Honda dealership. And anyway, if you guys remember that commercial, comment down below. But 36 months was advertised for financing all day long back in the 90s. And now, like, you go into a dealership, I mean, 72 months is not even a surprise anymore.
Oh, yeah.
Like, it used to be, it got to a point where everybody did 60 months, right? You were aggressively paying your car off if you did 48 months, right? Now, if you do 60, that's aggressive. 72 is the norm. 72 months, right? I remember going to a BMW dealership maybe 12 years ago, and I couldn't afford anything in there, but I'm a fan of the car, so I would just go and look. And there was a Z8 in the showroom. There was a BMW Z8 in the showroom, and the door was locked. I couldn't get in, but I just admired it from the outside. I looked at the sticker, and it was like 100 and something thousand on a car, maybe 110, 15 years ago. So add some inflation to that for today's prices, right? But so anyway, back then, I talked to one of the sales guys. I was like, dude, have you ever sold one of these? He said, yeah, I've sold one or two. And I asked him, I was like, yo, how are people affording these, right? I was just a kid, I was just like trying to understand, like, how do people who can afford these things do these things, right? Well, he was like, some people pay cash, but we offer financing, and the financing for this car is longer than traditional. So I said, well, how long was it? 108 months available.
Oh, damn.
Yes. That was like 10 years ago.
Damn.
Yeah.
That's very interesting.
I don't know what's available today because I don't look to finance cars that long. I personally just kind of like stick to 60, 72 months at the longest. I haven't really ventured out beyond that, but 108 was available then. So we saw the extension of vehicle loan terms be extended from 36 months to 70 to 60 to 72 to 84 to 108. I don't know if they have a 180-year plan, 180-month plan. Let me know if they do. But also, let's look at college, right? College was originally everyone who went to college, they paid for college. Then financing became available through private lending. Then the government got involved and they offered financing. Well, what happened with college expenses and student loans? And student loans became a thing. Well, the cost of college began to inflate now that financing is involved. Psychologically, you tend to spend more when you use a credit card or you finance than if you pay cash. So you're more willing to buy based on payments versus based on costs. And so when that happens, and the colleges, they're a business too. So when these businesses realize, oh, well, we can sell you a more expensive product or service because financing is available. Now I can afford this much. It's kind of like when you go into a jewelry store, right? You may have so much money in your pocket or your own card, but when you find out that the jewelry store offers 0% financing for a certain number of months and they're willing to give you a bigger limit, I guarantee the budget you had in your mind went up.
Oh yeah.
So same thing happened with the colleges. So it went from it cost you $5,000 to go to college for 4 years back in probably 1970, right? But today, 4 years, average person's walking out of college. I wouldn't be surprised if it cost them anything less than say $40,000 on average. Of course, there's less and more, but so so student loans were never a thing. Then they became a thing. We had the pandemic mortgage assistance for our crisis that we went through for the past 2 years. Many people went into forbearance, which thankfully was available, and it wasn't available to this extent back in 2008. So that's a crisis difference that we're both housing market related, but it's a difference, right? And they say history repeats itself, or yeah, it repeats itself or it rhymes or something like that. So this is kind of like history rhyming because the crisis is similar but not quite the same.
Oh,
Because
gotcha.
going
Gotcha.
into the 2008 crash was this massive spike in bubble, right? But to prevent the impending crash that everyone and their mom thought was going to happen when the pandemic hit, everyone and their mom thought the housing market was going to crash. And a big reason why it didn't crash when so many people couldn't leave their houses to go make money to pay for the houses that they were on the hook for, many people went into forbearance and the government said, yo, I got you. So you don't have to make payments for this period of time. Now, when this ends, one of the concerns is how many people coming out of forbearance can get back to paying. So that's kind of going into when you were saying like the foreclosures were going up by a certain percentage this year. So anyway, with increases or with these terms that were offered came 40-year repayment terms.
Yeah.
Because while you weren't making payments for these forbearance savior situations that the government offered, they said, well, how are we going to let these people pay this money back that we let them like not make payments on for this number of months? Oh, all right. Well, we'll have different programs available. One of them was simply extending the terms on the loan from say 30 years or 15 years, whatever you had, right? They're offering a 40-year repayment plan. So this is only available for certain situations. Well, if it's available in certain situations, are you telling me it couldn't eventually be expanded to allow more people to qualify to a point where it's commonplace to have a 40-year mortgage and not just 30?
It'll happen. It'll happen because these are more than likely the mortgages that were allowed forbearance,
Yeah.
that were kind of mandated forbearance were government-backed mortgages. So as soon as the government says, look, we will allow underwriters to extend this 40-year offer to whomever on these government private mortgages, don't count. That's on them if they want to do it. But the government-backed mortgages, once they give the thumbs up, the green light, then they'll offer it to everybody, and that'll be the new norm. And with what occurred because of the switch that was flipped in 2020 to send money out to keep people from having to make payments, low interest rates.
Right.
We have to make up for that. Well, we're going to raise the rates, but we'll allow you 10 more years on a mortgage to afford it. We're going to keep kicking this can down the road, but just realize and just know that eventually down the road, it's going to be worse than it is now.
Yeah.
Because it's all going to catch back up.
Yeah. And then we'll have to wait and see what they decide to come up with at that point. But I feel like it's just, economic evolution, and based on the circumstances that they've managed to find themselves in, what can we do to bandage this ship with all of these. We got masking tape, not even like good like waterproof tape. It's like masking tape.
Oh man,
it's like
got
blue
Scotch
haters tape.
Yeah, yeah. Like Scotch tape you're using to wrap Christmas presents with.
Oh yeah.
And the government continuously swipes this credit card that they are setting the limit on, which is a black card. It's limitless. And then when it's time to pay the bill, they come up with new ways to not pay the bill. So
And raise taxes.
I take that back. It's almost like they pay the bill with the credit card.
Yeah. Can I take the card that I owe this balance on and swipe it to pay the bill?
Okay. All right. We'll allow it.
Yep.
All right. Also, can I raise my limit, please? Anyway, thanks for joining. Thanks for having this conversation. If anybody else is still watching, we appreciate you sticking around. Like and subscribe, comment below. I will put the link to his channel in the description so you can go check it out. Epic Prep the Survivalist. Yes, Epic Prep the Survivalist. And from what I've seen so far, it's the basics of survivalists or prepping for survival, but also touching on and definitely deep diving on the finance and the economy side of it, and how to survive past the doomsday. Because the doomsday is not going to be this big old, nuclear mushroom cloud. Doomsday is going to be everything. Doomsday is going to be gas at $10 a gallon. That's the doomsday. And you need to be prepared beyond that for how you're going to be able to afford to survive.
Right.
That's how I feel. That's how I feel. Because, it's going to come down to, maybe there's rationing. Maybe there's, maybe the rationing in food supply is in price, and it'll automatically work itself out. That's what you need to be worried about. Stockpiling now and, pretty much dollar cost averaging on the lower price foods today is going to help you in the future, but eventually you're going to deplete those resources or they expire. So what you need to do is find ways to stockpile your money and find ways to continuously generate more and more and more so that you can afford what things are going to cost.
Right. That's really the only way to survive.
Yeah.
Because even if you can manufacture your own food and stuff like that, unless you figured out a way to just live in a tent year round, maybe in some Caribbean part of the world, you're going to be paying some form of rent or property taxes at a minimum, even if your house is paid off. Even if you bought land to put your tent on, you're going to pay taxes to some county or municipality. So you need money.
And they'll continuously go up. And I had someone tell me before, a friend of mine, and he's like, I need to find a way to save money. I need to find a way to cut these costs. I need to find a way to do this, that, and the other. I said, that's cool and all, but what you need to do is find a way to make more money, because that, like, no matter what, eventually you're gonna budget down. I mentioned Dave Ramsey. You're gonna do the beans and rice. You're gonna get lean, but everything.
And that's great. That's great, because sometimes it's easier to cut expenses before you figure out how to increase your income. It's great if you can do both.
Yeah.
But with inflation and hyperinflation the way it's going, like, your solution really lies in your ability to increase your income.
So if you guys are interested in not only the traditional prep and survival, but want to know more about increasing your income and alternate ways of additional income, multiple income streams, on top of the prep, because I've seen it. And actually his prep is going to be really cool, because you're going to go into the scientific macronutrient levels and nutritional value of the foods that you choose to prep with, because you don't want to prep with a bunch of junk. So that's going to be really cool. So check him out. Link in the description. Thanks for watching. Catch you on the next one.